Welcome to Talk Tickers, the place where we dissect the earnings calls that really move the needle. Today, we're diving deep into Intapp's Q4 fiscal 2025 results. And let me tell you, this was a report that got the market's attention in a big way. The stock absolutely took off. So let's break down exactly what happened.
And here's that reaction I was talking about, a massive surge of over 15%. That is a huge move. So what was behind it? We're going to unpack the numbers and, just as importantly, the story that management told that got investors so excited.
All right, let's kick things off with the earnings snapshot. And the headline here is simple. This was a clear, decisive beat. So let's start with the bottom line, right? Profitability. They posted non-GAAP earnings per share of 27 cents. Now, the street was looking for 23 cents, so that's a solid 4-cent beat. A really clear signal that the company is executing well on the profit front. And that strength wasn't just on the bottom line. It carried right through to the top line as well. Total revenue came in at $135 million. That was a 2.2% beat over what analysts expected, and maybe more importantly, it represents a really healthy 18% growth year over year. Okay, so looking at the table, you can see the beat on EPS and revenue, but here's what really got Wall Street excited. It's the quality of that revenue. See those SaaS and cloud ARR numbers? Cloud annual recurring revenue? That's the good stuff, the predictable, sticky revenue that investors absolutely love. And it jumped 29%. That's the engine of this whole business, and right now it is firing on all cylinders. But a great quarter isn't just about hitting the numbers. It's about how you hit them. So let's look at the story behind the numbers, because management laid out 3 key strategic drivers that are really starting to pay off. First up, and this is the big one, AI. Their applied AI strategy is no longer just a buzzword. It's a real growth driver. Check this out. Their AI feature Assist was part of 35% of new deal cloud wins this year. 35%. And to put that in perspective, last year, that number was just 8%. That is a massive jump. It tells you clients aren't just kicking the tires on AI, they're actually buying it. The second big driver, their partner ecosystem. Think of this as a massive Salesforce multiplier. They're not just selling on their own. They've got this whole network of partners helping them out. And it's working. Get this. Partners were involved in 17 of their 20 largest deals this quarter. 17 out of 20. That's just incredible leverage. And the crown jewel of that partner strategy is, without a doubt, Microsoft. The CEO, John Hall, explained it perfectly. He said it makes the budget question less of a question. And here's why that's a game changer. Clients can actually use their pre-existing spending commitments with Microsoft Azure to buy Intapp's software. So the money is already budgeted. It just makes the whole sales process so much faster and easier. And number 3, they're successfully moving upmarket. Their focus on big enterprise clients is really working. The proof is right here, a 49% jump in the number of clients spending over $1 million a year with them. That shows they aren't just signing up new customers. They're landing big ones and then selling them even more over time. That's the classic land and expand model, and they are nailing it. Okay, so that's the great quarter they just had. But as you know, the market is always looking forward. So how does all this momentum translate to the future? Let's dig into their guidance for fiscal year 26. And the full year picture looks pretty solid. Management is guiding for another year of strong double-digit growth. They're targeting total revenue somewhere between, call it, $567 and $571 million. And importantly, they expect non-GAAP EPS to be over $1. That shows that as revenue grows, profits are growing even faster. That's exactly what you want to see. But there was a little bit of nuance here. The guidance for the very next quarter, Q1, was a little softer on the profit side than people were hoping for. But management was really upfront about this. They said, look, this is intentional. They're spending money now on things like their sales kickoff and new marketing campaigns to pour fuel on the fire and really capitalize on the momentum they're seeing. It's an investment in future growth. So let's recap. You've got a fantastic beat, a solid guide for the full year, but this slightly softer near-term profit outlook. So how did the market weigh all of this? What was the verdict? Well, as we saw at the top, the reaction was clearly positive. The stock rocketed up over 15%. And look at the volume, more than 2.5 times the average. That tells you this wasn't just a small move. There was real conviction, big money behind this pop. Digging into the Wall Street analyst reports, though, the feeling was a little more nuanced. You could call it constructive, but not euphoric. On the one hand, you had the bulls at firms like Truist saying, hey, look at the AI adoption. Look at the partner wins. This is great. But on the other hand, you had more cautious voices, like Oppenheimer, saying, hold on, that Q1 guide is a bit soft, and growth is slowing down a little. It really captures the two sides of the story. So what's the takeaway here? It's that investors, at the end of the day, made a choice. They weighed the pros and cons and decided to focus on the positives. They prioritized that awesome Q4 beat and, importantly, a brand new $150 million share buyback program. And a buyback, that's management putting its money where its mouth is, signaling that they think the stock is undervalued. So that brings us to our favorite part, the next call. This is where we give you our take on where Intapp goes from here. With all this great execution, the strategic pieces falling into place, and the market clearly on board, what's the trade? What do you do with the stock now? We see this playing out in a few steps. First, on the next earnings report, Q1, we think they'll meet or probably even slightly beat that conservative guidance they set. Those investments they're making should start to show some early returns. Now, what does the stock do? Right after that report, we expect it to chop around a bit, kind of trade sideways as the market digests this new investment phase. But then, as we move through the year and we keep hearing good things about AI adoption and partner wins, we expect the stock to start a steady grind higher as that long-term growth story really comes back into focus. And so, for all of those reasons, we are initiating our coverage with an outperform rating. Look, this company has a lot going for it. They serve stable industries, their software is incredibly sticky, and most importantly, they are executing. The proof is in the pudding with their AI and partner strategies. They're making that tricky transition to being a more mature, profitable growth company, and we think the market is going to keep rewarding them for it. This is not financial advice.